A top venture capital firm reviews about 400 startups for every one they invest in. That's the real job of a VC. Not picking winners, but saying no to the other 399. For 50 years, that filtering happened one pitch deck at a time. An analyst would sit alone in a conference room with a stack of financial models and a yellow highlighter. Something just shifted. The firms writing the biggest checks in the economy are quietly handing that filtering job to algorithms. And the algorithms are finding things humans missed. It gets stranger. In 2025, AI startups pulled in $211 billion of global venture capital, roughly half of every dollar invested. So the same funds pouring money into AI are also using AI to decide where that money goes. A feedback loop has formed at the center of the startup economy, and almost nobody outside venture capital is talking about it. If AI changes how billion-dollar investment decisions get made, it changes which companies get built, which products end up in your hands, and which industries quietly die. Start with the numbers, because they're absurd. There are roughly 150 million startups active in the world right now. Top venture capital firms will formally review somewhere between 1,200 and 2,400 of them every year. And out of that, they'll invest in maybe 20. That's a funnel that throws away 99.3% of what comes through it. Imagine you run a hiring desk and you need to pick 20 new employees a year. Every candidate submits a 30-page portfolio stuffed with financial claims, market sizing, customer testimonials, and product roadmaps. And to do your job well, you can't just skim, you have to verify every single claim. That's what a venture analyst's week looks like, except instead of 30 pages, it's hundreds of documents, and instead of 20 candidates, it's thousands. For decades, this was survivable because firms had small teams and relied on personal networks to pre-filter the noise. That model broke. Founders can now generate a polished deck in an afternoon using the same AI tools the VCs are funding. The supply of decks has exploded while the attention span of investors has shrunk. Firms now spend about 35% less time on initial evaluations than they did 5 years ago. Not because they got smarter, but because they got buried. Speed isn't really the story. Sure, AI reads pitch decks faster than a human analyst. The bigger deal is what AI reads when there's no pitch deck at all. AI systems at modern VC firms pull data from GitHub commits, patent filings, niche hiring patterns on LinkedIn, and sentiment on Reddit and Discord. A pitch deck tells you what a founder wants you to believe. GitHub tells you whether their engineering team is actually shipping code or just shipping slides. Patent filings tell you whether a company has real intellectual property or just clever marketing. Hiring patterns tell you if a startup is quietly expanding into a new city months before anyone announces it. This is where personalization comes in. Each VC firm feeds its own investment thesis into the system, the kind of companies they like, the stage they invest at, the sectors they cover. The AI then scans the world for startups that match that thesis and flags them, often before the founder has even thought about fundraising. Machine learning models now screen startups against more than 50 criteria. They filter out 80 to 90% of deals before a human analyst ever opens the file. Think about what that does to the job. An analyst 5 years ago spent most of the week reading decks. An analyst today spends most of the week deciding which 10% of AI-flagged opportunities deserve a real conversation. The bottom of the funnel went from manual to automated almost overnight. The bigger shift is in due diligence, the deep investigation that happens once a firm decides a startup is interesting. This used to be the part of the job that rewarded patience. An analyst would spend days cross-referencing a financial model against public filings, reading every side letter, and hunting for inconsistencies in what the founder said versus what the numbers showed. Now consider this. When humans review contracts for problematic terms, they catch about 63% of the issues. When AI reviews the same contracts, it catches 87%. That gap, 24 percentage points, is roughly the line between a deal that goes smoothly and a deal that ends up in arbitration 2 years later. Picture two home inspectors looking at the same house. The first one walks through with a flashlight and a notepad. The second one sends a drone with thermal imaging through every room. Both will find the broken window and the water stain on the basement ceiling. Only one will find the slow leak hidden behind the wall in the guest bedroom. That's the gap between manual and AI-assisted due diligence. The most interesting tool in the new toolkit is something called a contradiction map. The AI pulls claims from the founder's pitch, projected customer count, projected cloud costs, projected hiring, and automatically compares them against external reality. Cloud costs from actual cloud providers. Hiring data from actual labor markets. Customer claims from actual customer reviews. Mismatches get flagged visually. Partners walk into investment committee meetings with a map of where the founder's story breaks down, not a stack of PDFs to argue over. The third place AI is showing up is inside the portfolio itself, after the check gets written. Traditional VC oversight happens every 3 months at a board meeting. An AI system can do it every morning. Modern dashboards now pull data continuously from each portfolio company and benchmark it against competitors in real time. They flag burn rate climbing faster than revenue. They flag runway dropping below 6 months. They flag engineers leaving a startup before anyone in the company admits there's a problem. On average, AI systems detect portfolio financial stress about 2.3 months earlier than a quarterly board review would. 2.5 months sounds small. In startup time, it's the difference between a graceful pivot and an emergency bridge round. It's also the difference between an investor walking in with a plan and an investor walking in to triage a crisis. One 2026 survey of VC dealmakers found that 85% of them now rely on AI to automate daily tasks. It's not a future prediction, it's already table stakes. Month-end reporting to limited partners, the people whose money the fund is investing, used to take a finance team days. AI-built dashboards now do it 60 to 70% faster and let LPs click around the data themselves instead of waiting for a PDF every quarter. But there's a catch that almost nobody talks about. As every firm in venture capital starts using the same AI tools, their AI-surfaced insights start converging. 5 different firms point their algorithms at GitHub and hiring data, and they all find the same 12 promising startups, which means they all show up at the same founder's door on the same Tuesday. This is why the role of the senior partner is quietly shifting. The old job was to pattern match. The new job is to design the pattern. Industry people are starting to call these partners thesis architects. They're not picking companies anymore, they're picking the criteria the AI uses to pick companies. And crucially, they're the ones who still make the unconventional, high-conviction bet that no algorithm would have flagged. In a world where AI filters for obvious quality, the humans who still trust their gut on a weird idea are the ones who find the outliers. The other wrinkle is regulation. The European Union's AI Act adds a new layer starting in August 2026. High-risk AI systems in financial services now need documented transparency, risk management frameworks, and human oversight. A black box algorithm that silently rejects 80% of startups is going to be very hard to defend in front of a regulator. Firms are responding by building hybrid setups, fast commercial models for public data, self-hosted open source models for anything sensitive like founder financial statements or unreleased product plans. The $211 billion flowing into AI companies in 2025 is the headline. The quieter story is how the same technology is reshaping the process of deciding where that money goes. Screening, due diligence, portfolio monitoring, even the pitch to limited partners, every step is being rewired in real time. And the firms that figure out how to use AI without handing over their judgment are the ones that will define the next decade of what gets built. If this is the kind of shift you want to understand before everyone else does, subscribe.